Yes, that is true. Bull markets are longer than bear markets. Hello and welcome to my channel once again. And today, in this short video, I'll take you through the bulls and the bears, the bull market and the bear markets in the last several decades in India. And what do we learn from this? And what you should do during the bear market, that is where we are currently right now. Probably not technically a bear market, but yes, we are entering into a bear market. So what we should do? So in this video, I'm going to cover the major bull markets and the bear markets, and why are bull markets longer than bear markets? What is the logic really? Is it true? And why is it true? And then finally, we will look at what do we do during this bear market so that we grow our wealth in the long term. So yes, once again, welcome to my channel. I'm Franky Fernandes, financial planner and a marriage coach. And my goal is to help young families like you in the 30s and 40s to grow your wealth. And this 30 and 40 is the golden years for you to build your relationship in your marriage and also your wealth. So this is the time when you should pay attention to investing, especially in the equities. So let's get started in today's video. What is really a bull market? What kind of market do you call a bull market or a bear market? Let's look at the definition. So bull market has been a period when stock prices rise over an extended time, typically by 20% or more from recent lows. Investor confidence is high, the economy is growing, and the corporate earnings improve, and greed is the dominating emotion. So bull market is a time when everything looks good. As they say, even the panwala gives you stock tips, right? So that is a bull market when it has reached a peak. So bull market is a period when the market keeps going up and up and up. There's a lot of confidence in the market. Corporate earnings are good. A lot of FIIs flows, foreign flows into India. If you look at from the Indian perspective, and a lot of investors are buying. The sentiment is good. The feeling is that markets will only go up, and that's why the dominating emotion is greed. In one of my upcoming videos, I'm going to cover a little more into fear and greed, these two emotions that dominate, especially during the bull and bear market. So right now, so when we talk about bull markets, it is the greed that is the dominating emotion. Now, what's a bear market? So bear market is when stock prices decline, exactly the opposite. Bull markets, the markets are going up. Bear markets, the markets are going down, but decline by 20% or more from recent highs. Investor sentiment is pessimistic, the economy slows down, and there may be high inflation, interest rate hikes, or global crisis. And what is the dominating emotion? Fear. So here you see exactly the opposite. Everybody is fearful, worried. People are withdrawing their money, stopping investments in equities. There is fear. People are worried. People even go through mental stress, mental health issues during the bear market. So bear markets can be really, really bad for many kinds of investors. Are you one of them? And I don't want you to be one of them, right? And I'm telling you why. I'll tell you why. And that is the reason I've made this video. So what we'll do is we'll quickly take a look at the historic bull markets and the bear markets. Historically, when all we have witnessed bull markets and when all we have witnessed bear markets. And mind you, I've been in this industry for the last 30 years and I have seen all these ups and downs. And so I know what I'm talking about. So let's take a look at it. So the historical bull and bear markets in India. You see, these are some of the major bull markets in India. Yes, from 2003 to 2008, around 5 years, and the gain was 600% approximately. It was driven by economic growth, strong corporate earnings, and a global liquidity boom. Sensex moved from 2,900 to 21,000. And I was part of this when I worked with a couple of companies. And this is where actually I started my investing journey in equities. Stocks, but more into mutual funds. And this is when I was working for Alliance Capital. I moved from SBI mutual fund into Sun FNC and then into Alliance Capital. This was the time when I've seen actually the market going up. I remember when it was 4,000, when it has touched 4,000, there was so much of excitement in Alliance Capital when I was working. So this is what is the boom. For 5 years, the market kept going up from 2003 to 2008. Then came the global crisis. And then again, the market started going up from 2009 to 2010. We look at the major bear markets also, but We look at 1 year of gap, and then for 1.5 years, 157% gains. Recovery post 2008 financial crisis, stimulus measures. All the governments across the world, including India, gave the stimulus measures, infused liquidity into the market, and FIs inflows led to rapid growth. That was for 1.5 years. Then from 2013 to 2020, we have 7 years, 250% gain. Political stability because Modi government reforms happened, GST implementation, and corporate earnings recovery. And then again from 2020 to 2024, till recently, till September 2024, 4.5 years of 230% gains. Post-COVID recovery, post-COVID recovery, global liquidity, and digital economy boom. So you see, the major bull markets, and they have been for several years, and the returns, the increase has been in 3 digits by percentage. Now let's take a look at the bear markets. So these are the major bear markets in India. During the Harshad Mehta scam 1992 to 1993, 56% drop in 1 year, Harshad Mehta scam, which led to market crash. Then 2000 to 2001, 55% drop in 1.5 years, dot-com bubble burst affected IT stocks. I clearly remember my NAVs, what I'd invested from 10 rupees, it had gone up to 18 rupees, and then it came down to 2.5 rupees. So that was the crash during the dot-com bubble. And for 3 years, all our investments, the returns was zero. Then again to 2008, 60% drop, such a huge drop, and it was there for a year. Global financial crisis impacted Indian markets a little more than a year. And then 2020, of course, we all remember 38% drop in 1.5 months, COVID-19 crash due to economic shutdowns. So what do you think? How big are the bear markets and how big are the bull markets? Isn't it very, very clear that the bull markets are longer than bear markets? If you have to quickly take an average, what is it? So in India, bull markets last for 5 to 10 years, and bear markets usually last from 6 to 24 months. This is the fact, my friends. Once again, I want to emphasize bull markets are longer than bear markets. And that's the reason the markets always move northeast. Did you see that? The markets have moved northeast. They always go up, right? The bull markets are longer, shorter bear markets. Bull markets, bear markets. Bull markets, bear markets. Yes, there are some countries in the world where the bear markets are longer. But if you look at USA, the one that we usually compare, they also have a very, very similar run up. They also, the way they grow, the markets have grown. So you see that the market always moves northeast, right? Now, why? Why is it that the bull markets are always longer than the bear markets? Just because everybody likes bull markets? Yes, we all love bull markets. We don't like bear markets. But if you loved bull markets and we always loved stock markets, there will always be bull markets. But there are times when there are bear markets. Let me just give you a quick analogy. Do you fall sick? Yes, you all fall sick. But do we fall sick for a prolonged period, or we are healthy for a prolonged period? Right? We're usually healthy, but then we fall sick. But then again, we are healthy, we fall sick at times. Yes, during COVID, probably a lot more fell sick for a longer period, but that was temporary. But otherwise, if you look at even a baby falls sick and then it recovers, falls sick and it recovers. And then over a period of time, you see that the sickness comes down. The time of sickness is very short, but the time of health is long. Why is it so? Why is it that we are healthier most of the times and sick less times? Simple. Because we always want good health. We eat well, we exercise, we sleep well. And that is the norm. That is the normal thing. Yes, there are times things go wrong and we fall sick. But what do we do when we are sick? We try to become better by eating healthy food, by taking medicines. Exactly. That is what happens in the stock market. So why are the bull markets longer than bear markets? Economic growth is a long-term phenomenon. If you look at our own country, in the last several years, what have we seen? A lot of billionaires have come up. New billionaires have been created. Many startups have started. Many industries have grown. A lot of innovation has happened. right? So economic development is a very long-term phenomenon. Every company wants to grow their businesses. They want to innovate. They want to do new things. They want to get technological advancement. For example, right now everyone is trying to use AI, right, and grow their businesses, bring efficiencies. So economic activity, economic growth is a normal, is a common thing. It's a long term. It's like you and I. We want to work, we want to do business and keep making money. It's a long term phenomenon. Our push is always to grow, push is always to do well. And that's what happens. But in bear markets, what happens? There are some short term glitches. For example, right now, the corporate earnings have slightly come down. The rupee has depreciated because of various reasons, because of Trump's coming and the tariffs increasing. Uh, Several things. These are some of these things, or maybe overvaluation in our country for small and mid caps and some of those. So those are all short term glitches. And markets are cyclical, remember. But structurally, India is strong. Economy is strong. You can watch my video that what can we expect the markets to go up in 2040, and why is it that what is this growth story? What is this GDP, etc. So you can watch that. So economic growth is a long term phenomenon. That's the reason why bull markets will always be better than bear markets. Investor psychology and market sentiment. Often what happens is during the bear markets, there's a lot of panic selling, there's a lot of fear. So people, so investors in panic sell, stop investing. So there is a quick effect on the markets. But during the bull markets, it takes a long time for investors' confidence to be regained, and hence the growth is slow. The bull markets are slower and slowly they grow, and that's why it takes a longer time for the bull markets to be seen. That's why they are longer. Bull markets are often longer. It's all got to do with the investor sentiments. Corporate earnings and productivity. Again, corporate earnings, if you look at a number of the companies, they all want to have good earnings year on year. And there's a gradual growth in corporate earnings, which keeps going up mostly because of innovations, because of new technologies that they would use, because of stimulus from the government, because of competition. So usually the corporate earnings and productivity growth takes time. It gradually grows. But when you look at bear markets, immediately there could be one or two quarterly earnings which are bad. And if there is something coupled with that, some global issues happening, all that when they come together, suddenly there's a fall. But the recovery is inevitable. So the focus again is always on growth, corporate earnings, innovation, new technologies, etc. Government and central bank intervention. How does this play in a bull and a bear market? So usually during the bear market, what happens? During the bear markets, usually the government offers stimulus. And what is the stimulus? They bring down the interest rates. Do you remember during COVID? The interest rates went on going down. Because the interest rates were down, that gave a stimulus to the economy. There was a lot of liquidity in the market. A lot of loans were taken. A lot of businesses tried to grow. So what happens is the government intervenes during the time of bear markets. But during the time of bull markets, the markets keeps going up. It is self-sustained. And there is not really any government intervention. During the bear market, the government intervenes as to quickly bring it up. For example, when you are healthy, you continue to live your life normally. You don't really pay attention to your diet or anything else. It is only when you fall sick, what do? You take medication and you change your diets. You work hard, you push yourself to get better. Exactly, that is what happens in the economy. The government wants the sick economy to become well. And that's why the bear markets are shorter and the bull markets are longer. So liquidity and long-term investing. Often most part of the year or years, FIIs or Indian domestic institutions or investors are often investing. SIPs are on, investing is on. That is a common phenomenon. They're regular. During bear markets, suddenly there could be some pullout. FIs may take money temporarily. Investors will stop investing. So the sentiments play with the psychology of, especially the investors, the retail investors, but the big investors, they have temporarily taken out the money. So that is where there's a liquidity issue temporarily, and that's why bear markets are smaller. But during the bull markets, there's often investing. SIPs flow, a lot of investors investing, FIs coming in, and that what happens is that gives a boost to the equity markets. And finally, innovation and structural changes. So this is something very similar to what we just saw about the economic growth is a long-term phenomena. So a lot of innovations keep happening, and innovations push the market up. Innovations push the corporate earnings up. Consumption goes up because of newer things coming in. For example, the AI, Chat GPT, and other things. So people are investing. Companies are investing into artificial intelligence, or the consumers are buying a lot of these stuff, right? So what happens is, because of it, because of innovations and because of all these structural changes that happen, that gives boost to the economy and countries across the world. So that's why bull markets are longer and bear markets are shorter, because only for a short period probably there could be a liquidity issue, FIs pulling out, maybe rupee depreciation, or some of those, or maybe wars happening, right? All these are temporary, right? Wars don't happen across every day, every week, every month, and all through the years. Yes, there are right now Ukraine war, and there was in the past the Israel and Hamas, but by and large, actually there is peace, right? And that's why the bull markets are longer than the bear markets. And now we come to the last part, which is most important, what you and I should do. So what should investors like you and me do during bear markets? You know something, what we should do? We should do exactly what we do in bull markets, right? Exactly. Let me explain. So we should invest in mid caps, small caps for long term, right? During the bull market, what was everybody doing? Investing in small caps and mid caps, micro caps, and risky stocks. Why? Because they believe that the market is only going up and up and they will gain a lot of profit. There's a lot of greed, but this is not greed. This is long term investing. So continue to invest in mid cap and small caps. Invest in thematic funds which have crashed. A lot of them went after thematic funds during the bull run and they got caught at the top of the hill. That is where they invested. But now everything is crashed. So now is the right time to invest in thematic funds. Invest in large caps for stability. Continue to invest in large caps for stability, because large caps should form a good part of your portfolio. Because when the markets crash or go down, large caps won't go down so much, right? Large caps probably have gone down by 14%, but mid caps and small caps have crashed by 20-25%. They are actually in the bear phase. Large caps are still not in the bear phase. Continue or increase your SIPs. The highest rewards that you will ever receive on your investments is what you invested during the crashes, during the bear phase. Markets have fallen by 14, 15, 20, 25%. So continue your SIPs. In fact, increase your SIPs. I would say increase your SIPs in mid cap and small caps. Of course, this is from me. I have a high risk profile, but please consult your financial advisor if you do not know anything. Okay, take his or her advice. Do asset allocation by rebalancing portfolio. Now, all that I'm talking about here, I have created videos, uploaded videos on large caps, I've uploaded videos on mid caps, small caps, I've uploaded videos on SIPs. Please watch them. Do asset allocation. Asset allocation is extremely important. This is also a video that I've made. This is the time to rebalance your portfolio. A lot of the young folks had invested all their monies into equities. So now is the time to bring down. If you are 30 years old, yes, 80% can be into equities, but 20% should be into debt or gold, right? At least 15%. And as you grow older, the equities become less and less. For example, for me, I'm in my early 50s. I have around 60 to 65% in equities. The rest is in debt. So I'm not so worried about the crash because I have enough into debt. I'm not worried. So your emergency fund should be into FDs or into short-term debt funds. From 0 to 1 year, it should be into short-term debt. From 1 to 3 to 5 years should be into long-term debt and hybrid funds. Above 5 years should be into equities, right? Whatever is your need, whatever ties up with your financial goals. This is the best time to look at your portfolio, sell your poor quality stocks and your mutual funds. Sell them, get rid of them. Because when the market goes up, they will go up slower than the better stocks, good quality stocks and good quality mutual funds. This is the time to buy good quality stocks and mutual funds. Do tax loss harvesting. Because a lot of your portfolio is in the red, this is the best time to sell off, especially the poor stocks. That is when you will book losses, and losses can be set off against capital gains, right? Short term losses can be set off against short term profits and short term losses, that is gains, capital gains. But long term capital losses can only be set off against long term capital gains. And if you do not have enough capital gains this year, it can get carried forward, but you can save taxes. And this is the year end. So this is the best time to actually do tax loss harvesting. So, yes, what are you thinking? Are you thinking worried, oh, this is the bear market? Remember, bull markets are always longer than bear markets. And bear markets are the best time to do a lot of things, a lot of structural changes in your own portfolio, and to actually save taxes. Continue doing your investments, especially what you would have done during the bull market. So, what do you think about today's video? Is there some learning for you? Are you afraid of this bear market? Again, remember, bull markets are longer than the bear market. If you like this video, please share with a thumbs up and subscribe if you have not subscribed. Please consider subscribing, and you can watch a lot of videos on finance and relationships. Thank you for watching this video till the end. I'll see you again.